Welcome back to The Explainer. So you're on the hunt for the absolute best stocks to invest in for 2026, right? Well, before you buy a single share, there is one absolutely crucial thing you've got to wrap your head around. The strongest stock isn't always the one that has already gone up the most. Today, we're prying open the ultimate investor's toolkit. We've dug through a mountain of financial research to bring you a crystal clear blueprint for building a rock-solid portfolio, especially in this rapidly shifting economic landscape. Let's dive right in. Here is our blueprint for today's masterclass. We'll kick things off with the 2026 market reality. Then we'll master due diligence, decode those tricky financial ratios, figure out how to beat our own psychological biases, and finally, bring it all together to build your actual portfolio. All right, let's jump straight into Section 1, the 2026 market reality. According to some recent, really eye-opening financial analysis from FinWest, 2026 is bringing us a couple of massive hurdles. We're talking persisting inflation and interest rates that are just staying higher for longer. But the absolute most critical shift here, it's the changing correlation between stocks and bonds. Historically, if your stocks took a nosedive, bonds generally went up to give you a nice soft cushion. While in this new high-inflation environment, that old reliable relationship is cracking. Basically, those traditional set-it-and-forget-it strategies, they might not protect your hard-earned money anymore.
Because of these wild shifts, you are going to hear a whole lot of noise out there. The media loves throwing around the term bear market every single time the market blips red for a day. But let's look at the actual definition from our sources at Paytm Money. A true bear market is a prolonged price decline of 20% or more from recent highs, completely driven by widespread pessimism. The takeaway here is that not every market correction is a bear market. Understanding this simple definition is your best defense against media fear-mongering. It literally stops you from making those impulsive, panic-driven trades.
Moving right along to Section 2, Mastering Due Diligence.
You've probably seen folks online shouting DYOD, do your own diligence. But look, that's not just skimming a snappy headline on your lunch break. As our sources emphasize, it is a comprehensive process. You need to dig into revenue and profit margin trends. Like, is the company actually consistently making more money, and are they keeping more of what they make? You've got to look at their debt, check out their competitors, and definitely look at insider ownership. If the CEO owns a massive chunk of their own company's stock, their personal wealth is tied to that share price. That generally means they are highly motivated to succeed. To put company size into perspective, look at a colossal number like $1.89 trillion. That is the market cap of a giant like Amazon. Market cap is just the share price multiplied by the total number of shares, and it tells us the true heavyweight size of a company. These massive blue-chip companies tend to be way less volatile. On the flip side, small-cap stocks swing around wildly, though they can offer higher potential rewards. You just have to know the weight class of the company you're stepping into the ring with. But here is the multi-million-dollar question. You do all this research, they have a killer product, a great CEO, but how do you actually know if the stock price flashing on your screen is a fair deal or if it's just wildly overpriced?
That brings us right into Section 3, Decoding Key Financial Ratios.
The experts over at Crux Investor use this fantastic analogy that just hits the nail on the head. Valuing a stock is exactly like buying a used car. Think about it. You wouldn't just look at a shiny car's sticker price and hand over your cash, right? No way. You check the mileage, you look under the hood, you ask for the accident history. Financial ratios are how we check under the hood of a stock. A stock's price means absolutely nothing in isolation until you compare it to how the company is actually performing financially. So here is your definitive analytical scorecard, highlighted by Charles Schwab analysts. Let's break it down. The PE ratio simply tells you what investors are willing to pay today for $1 of the company's earnings. But the PEG ratio? That one's even smarter because it actually factors in the company's growth rate. Then you've got ROE, which tells you exactly how efficiently management is using shareholder money to make a profit. PB compares the stock price to their physical, tangible assets. And that DE ratio? Treat that as your early warning system. It shows you if a company is dangerously surviving on a mountain of debt instead of real, solid revenue.
All right, on to Section 4, Beating Your Own Brain.
Let me ask you a serious question. What do you think is the absolute biggest threat to your 2026 portfolio? Is it rampant inflation? A sudden recession? A disruptive new competitor? Nope. According to behavioral finance research, the absolute biggest threat is you. Research published on preprints.org dives deep into these psychological pitfalls that literally destroy investor returns. We've got confirmation bias, which makes us only seek out news that tells us we're already right. Overconfidence? That leads to excessive trading and eating up your profits and fees. And we all know FOMO, the fear of missing out, which makes us jump into hyped-up meme stocks without doing a shred of due diligence. But the absolute most dangerous trap is called the disposition effect. This is a crazy psychological glitch driven by loss aversion. It makes us hold on to our losing stocks way too long, hoping they magically bounce back, while at the same time we sell our winning stocks way too soon just to lock in that quick, fleeting feeling of success.
So how do we fix our brains? Well, financial management sources all basically agree on this. Stop checking your account balance every single day. Seriously, staring at day-to-day fluctuations just creates stress, and stress leads to emotional, impulsive decisions. Active, anxious trading usually gets you wiped out by transaction costs. The true path to reward is having the discipline to tune out the noise and let long-term compounding do all the heavy lifting for you.
Which leads us perfectly into our final chapter, Section 5, Building Your 2026 Portfolio.
Before you pull the trigger and buy, you've got to understand the 3 layers of risk every single portfolio faces. Layer 1 is company-specific risk. What if the CEO suddenly resigns or they get hit with a massive lawsuit? Layer 2 is industry-specific risk. Think about what happens if new, sweeping government regulations hit the entire tech or healthcare sector. And Layer 3 is general market risk, the big stuff like inflation or recessions that drag the whole market down. How do you survive all 3? Diversification. You mathematically cannot put all your eggs in one stock or even one industry. You have to spread out your risk. Okay, so you know what to buy, but how do you actually put your money in? U.S. Bank research compares 2 main entry strategies. First is lump sum investing, which means taking your cash and dropping it in all at once. Mathematically, because markets generally trend upward over time, this often wins out by maximizing your time in the market. But psychologically, it is terrifying. That is exactly why dollar cost averaging is so powerful. By investing a fixed amount every single month, rain or shine, you end up buying more shares when prices are cheap and fewer when they're expensive. Best of all, it automates the whole process and completely removes your dangerous emotions from the equation. So, what does a resilient setup actually look like for 2026? Check out this sample diversified blueprint from Finvest. Notice anything missing? It is not that old traditional 60% stocks, 40% bonds split. Because bonds might not provide their historic safety net anymore, this modern blueprint allocates 50% to stocks, 30% to fixed income, but intentionally carves out 10% for real assets and 10% for alternatives. Those right there are your potential hedges against that stubborn, persistent inflation. Now, as your portfolio really starts to grow, you might want to level up your tools. Fiducian advisors highlight some advanced strategies like direct indexing. So instead of just buying a standard index fund, direct indexing actually lets you own the individual stocks within that index. This opens up some incredible tax efficiency strategies like tax loss harvesting. That's a neat trick where you sell off losing positions just to offset the taxes on your gains elsewhere. These are pretty complex tools, which is exactly why consulting with a professional advisor can be a total game changer to make sure it aligns perfectly with your specific goals. I want to leave you with a number that's just staggering. It proves exactly why all this discipline is totally worth the effort. Based on asset management data from U.S. Bank, if you would put $100,000 into the S&P 500 back in 1995 and you just used a patient buy and hold strategy, ignoring the noise, letting the dividends reinvest, and just letting compound growth work its magic, after 30 patient years, it would have grown to over $2.6 million. That right there is the ultimate reward for patience.
And that brings us to the core thesis of this entire explainer. Benjamin Franklin honestly hit the nail on the head. If you fail to plan, you plan to fail. Success in the 2026 market is not about getting lucky and finding some magic stock on a random internet forum. It is about having a comprehensive, disciplined plan. It's about actually knowing your ratios, doing the hard due diligence, diversifying and sticking to your guns when the ride gets bumpy.
So I'm going to leave you with one final kind of provocative question to chew on. Look inward for a second. Are you holding on to your losing stocks way too long out of pride? Are you checking your phone in a panic every single time the market dips? Are you literally letting your own brain sabotage your 2026 portfolio? Take a step back, use the toolkit we just built together today, and go execute a strategy that actually works. Thanks so much for joining me on this explainer, and keep learning.